Okay, today we're going to start a new chapter, Chapter 21, Capital Investment Decisions and Time Value of Money. So remember last week we covered some of the decisions on short-term business decisions. So do you remember any of them? A few? Remember we started from special orders, then we had pricings, whether to drop the department or not, what type of products that we want to emphasize, the ones with more contribution margin. And then we also had outsourcing decisions, whether to sell a product as it is or process it further. Right? Some of the short-term decisions that usually are made for just that current season or the future seasons, the near future. So some of the decisions we want to make in this chapter, we're moving on to a longer time frame. Okay, so the considerations will be a little bit different, and the tools that we'll be using is also different. Okay, so you'll be introduced in this chapter 4 different analysis tools to determine whether or not we want to invest in this long-term assets. Okay, so the investment term that we use in this chapter is not referring to investment in stock or investment in bond, but rather the investment in long-term assets purchase or not. So whether to spend money on updating websites, purchasing other machinery, equipments that can help manufacturing cycle or not. And then these are some of the tools that you'll be introduced in different sections to determine whether or not, again, it's a cost-benefit analysis. So whether the money you're spending on this long-term asset actually provides us enough return and exceeds this cost that we spent earlier. So the whole point of investing in something, hoping to get more return out of it. Okay, so first section will be describing what is capital investment, what is the general process of doing capital budgeting for long-term assets investment decisions. And then we'll be using payback period, rate of return methods, the first two methods that usually is used for long-term decisions but relatively in a shorter time frame. So 3 to 5 years decisions in a shorter lifespan, we'll be using these first two methods. Third and fourth, we'll be factoring in time value of money. So we'll be calculating present value, future values, annuities. With some of the concepts perhaps you also learned in other finance courses, we'll be combining this with managerial accounting concepts. So first of all, what is capital budgeting? This is the decision that companies, managers need to make on whether or not to invest money in long-term assets projects. So they will be evaluating which type of projects will provide them the highest profitability and then aim toward investing money in that project. So you may have several options, alternatives. The same as short-term business decisions. Remember, we may be purchasing from different supplier, different vendors. You'll be getting a different price. So which one at the end gives you the most profitability, that's the one that managers will want to invest money in. Okay, so these long-term investment decisions, perhaps, for example, could be developing websites, could be updating, upgrading some of the machinery, purchasing a new facility, new manufacturing plant, automating some of the production steps that in the past perhaps with manual processes in the past. So some of the examples here, again, the investment we're referring to here is not purchasing stock, not bond purchases or long-term debt, short-term debt. We're referring to the investment in assets. Okay, so who remembers statement of cash flows in financial accounting? Do you remember any of the structure? General structure. There's an operating cash flows. And we also have investing cash flows. There's also financing cash flows. Remember, statement of cash flow is all about money in, money out, cash part. Operating reflects all the sales, revenue, expenses, cash inflow, outflow. Investing section, the second section is statement of cash flow. Investing section refers to the money that you're using to purchase long-term asset and the money that you're collecting if you sell long-term asset. So here, all the investing term we're referring to here is referring specifically gearing toward long-term assets purchase. And we're trying to figure out whether the money we're spending on this long-term asset upgrade or purchasing new machinery actually gives us additional profit later on, and that profit exceeds the initial cost. So we're comparing which one is higher. If we're getting more profit out of this investment, then of course it's a good project. We can go for this project. If overall the profit is not high enough, doesn't even cover the initial cost, then there's no point to upgrade these websites or update this, or upgrade or purchase new equipment machinery if overall the return is not enough. Okay, so we'll be weighing the two between initial cost investment and the return that we're getting from the asset. But again, this long-term asset affects longer time frame. It could be 3 to 5 years, 10 to 20 years. So we want to know what is the estimated value as of now. Okay, so these tools will be helping us to look at different angles of the projects. What is the time period that we're getting the money back? Or what is the rate of return that we're getting? And of course, for longer time frames, assets investment, what is the present value as of now? Here? We'll be going over this in detail, but it's average annual operating income. Okay, and this is annual average investment that you made. Okay. Okay, so overall this chapter was surrounding on 4 tools here. Payback period, rate of return, net present value, internal rate of return. So we'll be going over each and every one of this in details in terms of formulas, exercises that links to how we actually use the tool. But generally speaking, just to give you a heads up, again, first 2 methods are usually used as a screening process. So usually are not used alone, especially for some of the investments that last for 10 years or 20 years. As long as it's more than 5 years, usually we also combine it with a 3rd tool and a 4th tool, considering time value of money also. Okay, so payback period simply just understands what is the time frame that we're getting the money back from this investment of assets, time period. Rate of return, moving toward profitability side, what is the profit that we're getting out of it comparing to the investment toward this project that we made earlier. Present value, internal rate of return, we'll be considering present values, considering the interest rates, time period, referring to some of the annuity tables to figure out what is the present value factor, future value factor, and what is the present value of this investment project based on the estimated return that we make. Okay, so all of these tools we're trying to project and estimate. Remember the key term here is estimation. What is the estimated cost that we're spending? What is the estimated return that we're getting? So it's not really the exact number. So in reality, of course, in the problems that we go over in class, we assume that the return is the same. We assume that we already figured out every single year's return. But in reality, sometimes the numbers, we need to adjust it as time goes by. So perhaps when it moves to 2nd year, we need to adjust it. We realize this asset is not really giving us $60,000. It's just giving us $50,000. Then we need to do further adjustments. So just keep this in mind that all of these is a process of estimation. So we're estimating different alternatives, different options, which one gives us the possibility highest profitability.